Real estate investing in Canada. So here's how you can make at least 30% return investing in real estate in Canada. Actually, to be more specific, in Montreal, Canada. So I want to show you an example of a real life scenario. So these are real numbers. So in the suburbs of Montreal, if you buy a condo and rent a brand new condo, new construction, and rent it out for 5 years and sell it at the same price, you can actually make 35% on your investment, and I'm going to show you how. So let's say you buy a two bedroom apartment in the suburbs of Montreal. It'll cost you $200,000, and these are real numbers. And you put a down payment of 5%, which is the minimum required, which is a $10,000 down payment. You're gonna have to pay a mortgage insurance premium of about $7,600. So your beginning mortgage balance will be $197,600, and with a mortgage rate of 3.14, that's gonna give you a mortgage payment of $949. So in the first scenario, with a 5% down payment, your mortgage payment will be $949. Your property taxes will be $250. That doesn't change. Condo fees $90, condo insurance $20, so it's a total cost of $1,309. If we compare to the second scenario where you put 20% down payment so that you don't pay any mortgage insurance premium, so that's going to be a down payment of $40,000, and you'll have a beginning mortgage balance of $160,000 on a $200,000 purchase price, and assuming the same interest rate of 3.14. Usually when you put 20% down, the interest rate is a little higher, but just for this example, we're going to keep the same interest rate, and it's going to give you a mortgage payment of $769. So in scenario 2, with the mortgage payment of $769 and everything else being the same, you're going to have a total cost of $1,129. So a 2-bedroom apartment in the suburbs of Montreal can be rented at $1,200 per month. So like I said, these are real numbers. Now in scenario 1, the cost is $1,309, so you're going to have a negative cash flow of $109. And in scenario 2, you're going to have your total cost is $1,129 per month, so you're going to have a positive cash flow of $71. Also, a good way to increase rent is by furnishing the apartment. So you can furnish it in a cheap and expensive way and probably charge like an extra $100 a month to get higher rent. Now you might lose possible tenants because some people will have their own furniture that they want to take with them, but you might also increase your chances of renting it because some people will find it more convenient to come into an already furnished place. So the risk really with buying real estate and renting it out is making sure that every month it is rented. So to avoid that risk, you obviously need to make sure you're buying in an area that's easily rentable, and you need to choose your tenants wisely so that they don't damage your property, or else your property will lose value. So besides these two risks, I personally don't see any risk in real estate investing. So let me show you how you can make 35% on your investment. So if we continue with scenario 1 with the 5% down payment, and let's say you decide after 5 years you're going to sell the apartment because you don't want to spend on maintenance or repairs. So you bought a brand new condo, brand new construction, rented it out for 5 years, and then sold it at the end of the 5-year term to avoid any expenses on maintenance or repairs. And let's assume you sell it at the exact same price you bought it at. So worst case scenario, you sell it at the exact same price you bought it at. Although that's unlikely because in reality, price will go up. So if you sell it at the same price you bought it at, so you're not going to make any capital gain from the selling and purchase price, but you're going to get equity because the rent you were collecting was paying down your mortgage balance. So your mortgage balance at the end of the 5-year term will be $169,350. So $169,350. So the difference in mortgage between your beginning balance and your ending balance is $28,250. From that, you're going to remove $6,540, which is the monthly negative cash flow that you were accumulating for 5 years, and you're going to remove $4,000 of closing costs like notary fees and welcome tax. So you're left with $17,710 of equity that you've gained in 5 years if you bought a 2-bedroom apartment in the suburbs of Montreal and sold it at the same price you bought it at. So now that's $17,710. That's profit you gained in 5 years. So now if you're going to divide that by 5 and then divide that by your initial investment, which was $10,000, right? So that was the down payment that you put in to begin with in order to get access or to have access to that property and rent it out. So that's 35%. So this is a real life scenario of real estate investing where you can make 35% return on your investment. So it's not a big investment. It's only $10,000, but it's still 35%. And nothing stops you from doing this more than once. So 10,000 here, 10,000 there, and you keep making 35% on everything. Now, the only issue with real estate investing is that it's not always easy to get a mortgage. You need to have good credit, you need to have a steady job, you need to have the funds, you need to have the down payment, and you need to be able to pay for the mortgage. Your income plus your potential rent need to be enough to pay for the mortgage. Plus, banks will only consider 40% of your revenue towards debt. So if you're making 100K a year, you're only allowed to spend $40,000 on debt per year. So let's say you're making $5,000 a month, you'd be allowed to spend $2,000 in debt. So if you already have a car payment, credit card debt, line of credit, all that will be deducted from your $2,000. So it doesn't give you much room towards a mortgage. Plus your potential rent, not all banks will take 100% of your potential rent as income. So most banks will take 50%. There are banks that will do 100%, but you have to find them, and depending on the scenarios. So if you're able to get approved for a mortgage, real estate investing is definitely the way to go. If you choose the right area, the right property, and the right tenants. Now, if we look at scenario 2, where we also sell at the same price we bought it at, but we had a down payment of 20% instead of 5%. So the balance at the end of the 5-year term on the mortgage will be $137,125. So $137,125. So the difference between the beginning balance and the ending balance is $22,875. So that's the equity that you've gained in 5 years. Plus, you're going to add to that the cash flow that you gained every month of $71. So 71 times 60. And you're going to remove the closing costs of notary fees and welcome tax. So you're going to be left with $23,135 profit that you made in 5 years. So you're going to divide that by 5. And to calculate your return on investment, in this situation, you put down 40,000. So your investment is 40,000. So we're going to take our yearly profit divided by 40,000, and that gives you 12%. So in the scenario where you actually put 20% down payment, so you actually put more money down, you're making a lower return on investment. But in the scenario where you're putting 5% down payment and you paid insurance premium of 4%, so that's money wasted. That's an extra cost. You still end up making a higher return on investment because your investment was only $10,000, but you got equity paid down. So that is explained because you're leveraging the low interest rates of the mortgage. That's why it's not always a good idea to pay down your mortgage quickly. You can do better things with the money that you're going to use to pay down your mortgage. You could invest it and get better returns than paying down your mortgage. And here's an example. Because if you're putting a higher down payment, you're making a smaller return on investment. Now remember, this is if you sell at the same price you bought it at. Now assume you were able to sell it at $230,000 after 5 years. So that's an extra $30,000 to your profit. So 30,000 plus 17. So that's a 95% return. If you're able to sell at 230,000. So if you're able to sell at 230,000, you'd be getting a 95% return on your investment. And in the case where you put down 20% down payment, you'd be making a 27% return on your investment if you're able to sell at 230,000. Now, I didn't include selling fees like real estate fees because in Quebec or in Montreal, there are many ways to sell without having to pay a realtor. The max I guess you'd pay is $1,000. So maybe I should add an extra $1,000 here. Okay, so 93% if you're selling at 230 and 26% in the scenario where you're putting 20% down payment. Now let's say we sold at the same price, you'd still be making 33% return on your investment. Now assuming you can qualify for a mortgage, you can keep repeating the process. Either every year Or you can even use the equity that you've gained from one property, use it as down payment for a second property, and just keep repeating the process. So yeah, so this is why real estate investing in Canada is great. Just want to remind you that these are real numbers in my area. That these are real numbers in my area. It might be different in your area. It might be higher, it might be lower. You can probably make a better return, or you can probably make a lower return. So it depends on the cost, of course, the purchase price, and it'll depend on how much you can how much rent goes for in your area. So it's really important to choose a good location so you can get something that's easily rentable, so you're never forced to pay the mortgage yourself. You always have rent that pays for your mortgage. It's very important to pick the right tenants, of course, people that pay on time and that always pay, and of course that will not damage your property. And it's important to get approved for a mortgage, so you need good credit, stable job, and no debt, so that your income can be sufficient enough to pay for the mortgage. And not all banks consider rental income at 100%. So most banks will include only 50% of the rental income to evaluate if you qualify for the mortgage or not. So these are just things to consider, but definitely, as you can see, investing in real estate generates a really good return. So I'm going to provide a link to this website called Rate Hub, which is a great Canadian website that compares financial products. And of course, if you have any questions, leave them in the comments below. If you like this video, please like it, share it with your friends, and subscribe to my channel. Thanks for watching.